So welcome class. This is still the November. We're still in the November 2023 paper, and we'll be doing question 5 of that paper. So explain 3 uses. This is 5A. Explain 3 uses of the concept of time value of money to a business. 3 uses of the concept of time value of money to a business. Now, time value of money, simply put, means that money grows with time, and that the value of a shilling today will not be the value of a shilling tomorrow. The value of a shilling today will not be the value of a shilling tomorrow. There are so many factors that affect the value of a shilling, and those factors, in brief, will cause the value of a shilling to change with time. And so whenever we are making decisions about money, we need to factor in the change in the value of money over time. And we've said that the money's value will keep on changing depending with the so many complex factors that will end up affecting the value of our money, or the value of money. Now, time value of money simply appreciates or recognizes the fact that money appreciates with time. And so when we can simply put it as the cost of money. The cost of money. For example, if somebody lends you his or her money, after some time he'll expect to be paid back his money, but of course there is an opportunity cost. There's what he had forgone for the sake of giving you that money. So for example, if I had 100,000, if I use this money on my own errands, my own ventures, I expect this money to grow, especially if I have invested. I expect this money to grow, and maybe after 1 year, it will have grown to say 120,000. This is the nature of money. Money creates itself. So by virtue of me having this money simply means that I'm in a position to multiply the value of this money to some other, value of greater value. So if I was to give you this money, it means that I've empowered you to do whatever it is that you can do that will help you realize the greater value of this figure. So I'll have lost to the extent of what you'll have gained. So we talk of the cost of this money, over time. That is the time value of money. Simply put, I can say that opportunity cost. What I'll have lost, or rather, by giving you the money, I'll have given you the powers to invest that money and get all the returns that come with that money at my cost. So you'll need to pay me also. I'll not just give you money for free, because you are the one who is going to get the benefit. So the cost of the money that I'm going to give you, so that I also get some benefit, that will also be captured under this concept of time value of money. So let me just define it in the simplest words possible, what time value of money is here for the sake of your exams. So time value of money is simply a concept that says that the worth of a shilling today, a shilling today is not the same as the worth of a shilling tomorrow. Tomorrow it will have greater value. So we need to factor this in. So if I'm giving you my money today and for you to use and then return it back to me, refund me the money later, it means that you'll have to refund me with something on top, because the value of a shilling today is not the value of that shilling tomorrow. A shilling today, tomorrow, possibly it will be 1 point something. The assumption is that it will have grown in value. That is the time value of money. So what are the uses of the time value of money? Time value of money has found a lot of application in the business world. And the most obvious one is in what we call loan advancement or amortization. It's actually this concept that has enabled financial institutions to lend money, because they lend money and charge an interest on whatever it is that they have lent. They have advanced to the borrower. So they'll always give you money, but they will calculate the value of that money in relation to the time that you are going to hold that money, and they'll expect you to pay back whatever they have advanced to you plus the cost or the interest. That interest is one of the products of this concept of time value of money, and it is the interest that serves as a motivator for the financial institutions to advance loans. So it is through this concept of time value of money that we have loan advancement, and we all know the importance of loan advancement. Loan advancement helps you to get to have access to funds which otherwise you will not have access to. So it enables businesses, and that of course has an impact on business growth, country's economy, and all that multiplier effect. Then you also have capital budgeting decisions. This is basically the investment decisions. When you are making investment decisions on whether to put your money in a certain project or not, remember, when you put your money in that project, it will be cash money, in the expectation that you will get some money later. Now, whatever it is that you get later should have considered this time value of money, that the value of a shilling today is not the value of a shilling tomorrow. If it doesn't consider this concept of time value of money, chances are very high that you'll end up with making a wrong decision, which might basically lead you into losses. So the whole concept of time value of money helps us when making the capital budgeting decisions. Capital budgeting decisions are decisions that involve long-term assets. Are we going to get returns that are commensurate or greater than what we had invested, putting in mind the change in value of the shilling over time? That is the question that will be seeking to answer when we talk about capital budgeting decisions. So the whole concept of time value of money helps us to make accurate decisions, know if the business or a venture or a project will be profitable in the long run, or if it will not be profitable in the long run. Of course, if it won't be profitable, we will not go into that particular project, we will not put our money in that project. But if it's profitable, then we are going to put our money into that project. The third use of this concept of time value of money, actually I would have said personal financial decisions, but we are talking about uses of this concept to a business. So you can simply say that it helps in the decision making process, especially when we talk about things like the sources of finance. There are so many sources of finance. And all of them have various different costs attached to them. Like we have retained earnings, we have debentures, we have equity, we have, and all of them have this concept of time value of money. Normally we talk of the cost of capital. We talk of, there are different ways of calculating this cost of capital. So the whole idea of the cost of capital is pegged on what? On this concept of time value of money. And so this concept of time value of money will help us make a decision on which source of fund possibly to go for. And of course, it influences so many other decisions, even the dividend payout retention decisions. These ones are also influenced to a great extent by the concept of time value of money, because the investors will want good returns of their investment, and so they will be trying to calculate the actual value of their money, of course with time element in a picture, and what they actually get from the business as dividends. If the two don't tally, of course they'll make a decision which can either favor the organization or be against the organization. And I think we can go on and on and on, but just for the sake of making it easier for you, I will advise that you, because this is a financial management question, I'll advise that you always have the 4 key decisions with you when you are answering such like questions. The 4 key decisions or functions of financial management, which are the liquidity decisions, the financing decisions, the investment decisions, and the dividend decisions. And if you check keenly, all these are affected by the concept of time value of money. So all these depends with how you are going to explain, but all of them are affected by the time value of money. So one of the uses of the time value of money is, it helps you also learn how to manage the liquidity, because if you at any time you don't have sufficient liquidity in the organization, you will end up this side, and this will be a cost to the organization. It comes in with a cost. So generally, it affects all the decisions, the key decisions in an organization setup. Okay. Part 2 of the question. ABC Company Limited has identified a venture that will cost 100,000. The venture will generate the following cash flow for the next 5 years. The venture will generate the following cash flow for the next 5 years. So, the venture initial capital is 100,000. Initial capital 100,000, and then the first year 50,000. Second year 14,000, third year 10,000, 26,000, 16,000, and 16,000 the fifth year. So calculate the payback period. Payback period simply answers the question, how long will it take? How long would it take for the company to recover its initial invested capital? How long will it take for the company to recover its initial invested capital. So this company here is investing 100,000, and then these are the cash inflows over time. You can see we're talking about 50,000, 14,000, 10,000, 26,000, and 16,000. So how long will it take for the company to recover its initial invested capital of 100,000? So you simply come here and say year 0, the capital invested is 100,000. Then year 1, capital invested was 50,000. Year 2, the best thing is for us to have this will be the year. Then we have the cash flow. Then we'll have the cumulative cash flow. So year 1, 50,000. So cumulative still 50,000. Year 2, how much did we sell? 14,000. We received 14,000. So cumulative is 64,000. Cumulative simply means you add total that you have received so far. Third year, 10,000. So cumulative 74,000. Have we recovered the 100,000? No. Year 4, 26,000. So cumulative 100,000. And year 5, 16,000. Cumulative 116,000. So let's go back to the question. Calculate the payback period. And I've said the payback period simply answers the question, how long does it take for the company to recover its initial invested capital? In this question, it's very clear that it will take how many years? 4 years for the company to recover its initial invested capital. The initial invested capital was 100,000, and you can see in our 4th year, we are going to recover a total of the amount that we had invested in this particular project. So the answer to this question is 4 years. Calculate the payback period. This is the computation of the payback period, and the time it will take for us to recover the initial invested money will be 4 years. Thank you. Let's look at the last part of this question. Tender Wema keeps her petty cash book on Impress system. The Impress is 25,000 for the month of April 2021. Her petty cash transactions was as follows. So on April 1st, he received April 1st, the petty cash balance was 1130. Second, petty cash presented vouchers and obtained cash 23,000. On 4th, bought postage 350. On 9th, paid a creditor 2350. Paid bus fare 1720, the same 9th. 17th, he bought envelopes. 23rd, received cash for personal telephone call. 26th, bought fuel. Prepare petty cash book as at 30th April 2021. Now, petty cash book is one of the subsidiary books that is used to keep the minor expenditures in an organization. These small expenditures in an organization. And those small expenditures, of course, with time they will be significant, and so we cannot assume them. So we normally have a book that will be used to maintain all those small expenditures in an organization. It is the book that is called the petty cash book. And these are some of the small expenditures. So let's just see how a petty cash book is prepared in an organization. Normally we have what we call the vote heads, and this is how it looks like. Sorry for those crooked lines, but we have quite a number of columns, and most of these columns will have the vote heads. So we are going to have vote heads. And for this particular question, we may not have so many vote heads, just from the look of things. So let's just have it up there. Of course, we have the heading. This is a petty cash book. Petty cash book. You may also want to have the name of the organization. This is Tender Wema petty cash book. And you can also have, in this case, talk of the month of April. The month of April. So we'll talk of tender wema, petty cash book, the month of April 2021, like that. So then we our petty cash transactions as follows. So this is April 1st, petty cash balance 1130. So we come here, we are supposed to feed all this information here. We'll have the date here. Then you have the particulars here. Then here we have the credit part of it. And then the whole of this side is the debit part of it. So we'll also have the debit in shillings. We'll have the credit, the debit, and then you have all this will now be our vote heads. So the various vote heads, depending on the question, you need to have vote heads that will capture all the various expenses, that small expenditures that are going to be incurred in that organization. So we'll start with the first item, 1st April, petty cash balance. Simply write here balance, petty cash balance. This is balance brought forward, and the amount is 1130. 1130. So these are credit. So you show it on the credit side as being the amount that the organization started the month with. And then on 2nd April, petty cash presented vouchers and obtained the petty cash presented vouchers and obtained cash 23,000. So you can simply say bank. The assumption is that this money came from the bank. So if that is the case, we will credit the bank and then debit. This money will come from the bank and come straight into our petty cash. So we are going to credit petty cash because it's our money. We have it. So this should be debit side. So this is debit, this is credit. Look up the bank. So this is debit, this is credit. So we are going to credit the bank account and then debit the petty cash. So we'll have it here. How much is this? 23,000. 23,000. Yeah, this is now correct, because normally for a cash book we have the debit side and the credit side. So debit, cash you debit, cash in for you debit, cash out for you credit. So this, since this is a petty cash, we are going to credit the bank account, with 23,000, and then we debit the petty cash account with 23,000. Okay. So we proceed. This is 23,000. Now, bought postage. Now, all the expenditures will have to be captured in this column here. So, bought postage will simply come here and say on 4th April, postage, how much? Postage 350. So, 350. Then we come here, we say postage 350. This will now be our vote head. So the first column is to capture all the expenditures. Then we can distribute them now to the various vote heads. Then on 9th, paid a creditor. Creditors are ideally are not supposed to be in a petty cash book, because this is one of the, the assumption is that the petty cash book is supposed to hold only small expenditure, and we expect creditors to be not that small expenditure, because most businesses will depend, creditors come from purchases. But since it has been included here, let's assume that the creditors are, these creditors as a result of the small expenditures, these minor expenditures in the organization. So in that case, we'll just have creditors here as a vote head, and then show 2350. This is the total. Then have it there under the creditor vote head. Then bus fare, we can also have bus fare. This was 9th April. So again, we come here 9th April. Bus fare 1720. So write bus fare. You must put here the total 1720. So that column is, this column is simply for the totals, and then you can have now Now, bus fare, of course, it doesn't fall under the postage, doesn't fall under the creditor, so we can have another vote head here for the bus fare and then include it here as 1720. Then, of course, this will be dashes like that. This will be dashes like that. Then we'll have envelopes, 17th. Now, 17th April envelopes. You can include envelopes under postage. They are quite related. So if that is the case, you simply say postage, envelopes, how much, 700. Then you come here and include them under postage. Because envelopes and postage almost the same. You can have them under the same vote head. And we'll post this in the ledger book under postage, under that postage vote head heading. So 700. Then received cash for personal telephone call. So you can talk of telephone call, telephone. How much is that? 680. So we can see that one we created a new vote head for telephone. 680. So here you say telephone. How much? This is on 23rd. Then lastly, 26th, you have fuel. And fuel and fare possibly can go together. Maybe we can call this, instead of calling it fare, we can call it travel vote head. Travel. But it's also okay if you can put fare and then fuel. It depends. Though they all involve traveling. So if you can put them under one vote head, you can simply call that travel. So fuel 1000, have it 1000 here. Then of course under the vote head of travel, include the 1000. So we are done. We are done with that. So we need to close the books at the end of the month. How do we close the books? Get the total of all the vote heads. So we don't have these two vote heads. So we'll just go away with them. So get the total of the vote heads. Sorry, my lines are disappearing. So get the total of the vote heads. That's how we go about it. This one you may choose to just have it like that, and then have it again like here, like this. It will be better like that. That is how we close the books. So this is 680, this is 2720, this is 2350, this is 1050. Add all this, 680 plus 2720 plus 2350 plus 1050. You add all of them, you'll get the total. Just add them here very fast. So this is 680 plus 2720 plus 2350 plus 1050. That gives us 6800. So compare this side. This is 6800. And then this side, how much do we have? 24,130. 24,130. So we pick the side with the highest figure, 24,130. 24,130 as our balancing figure. Then we'll have now on 31st April, we are closing the book, so we'll say balance carried down. So we take the highest figure on the debit side and the credit side, compare, and take the difference. Now you can clearly see on the credit side we have a total of 6,800. On the debit side we have 24,130. So let's get the difference. 24,130. The difference is 17,330. So we'll have here 17,330. That is the difference. So we come here and say 1st May balance balance carried down. 1st May will now be this 17,330. What we closed the month with is what will start the month, the following month with. This is the total amount of money we had, 24,130, and in that month we only spent this. This totals to 6,800. This is how we spent that money, and so if we had this at the beginning of the month and we spent 6,800, what do we have at the end of the month? 17,330. And that is the same amount that we will start with the following month. Just the same way we started with 1130 on 1st April. That's the same way we'll start with 17,330 in 1st May. So thank you. Let's meet in the next question.